Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. A developing story that we're following out of India this morning. An Air India Boeing 787 aircraft traveling to London's Gatwick airport crashed shortly after takeoff in what stands to be the most serious accident involving Boeing's most advanced wide-body airliner. The flight was carrying 242 passengers and crew. Video footage shared on social media showed a giant plume of smoke engulfing the crash site, with no reports of survivors. The pilots in command issued a mayday call immediately after takeoff to air traffic controllers, according to India's civil aviation regulator. Boeing shares were down by more than 7% in pre-market trading amid the crash. Plus, keeping an eye on stock futures this morning, investors watching the latest tariff plans from President Trump. The president said he will set unilateral tariff rates within the next 2 weeks, ahead of an earlier deadline. Trump had initially suggested he would engage in talks with each partner, but has moved away from that idea, prioritizing talks with some key economic partners and acknowledging that the administration lacks the capacity to negotiate dozens of individual deals. And bond yields falling this morning amid the latest read on inflation. PPI data, producer price index from May, coming in cooler than expected, increasing odds for Federal Reserve rate cuts this year. The PPI report follows May consumer price data that showed a fourth month of tame inflation. While the impact of higher tariffs has so far been modest for Americans, economists see price pressures building in the second half of 2025 as companies look to guard against further margin weakness. An Air India Boeing 787 Dreamliner crashed shortly after takeoff on Thursday. Thick plumes of black smoke seen over the airport in video taken by bystanders. 242 passengers and crew members were on board the flight heading to London's Gatwick airport. The plane crashed into a building housing medical students, according to local media. Aftermath from the scene showed billowing smoke rising over the area and firefighters on charred streets. Air India confirmed the flight was involved in an accident after takeoff in a post on X. India's Prime Minister Narendra Modi called the tragedy heartbreaking beyond words. In a statement Thursday, Boeing said it's in contact with Air India regarding Flight 171 and stands ready to support them. Our thoughts are with the passengers, crew, first responders, and all affected. Boeing's safety record has faced scrutiny following two fatal crashes of its 737 MAX aircraft in 2018 and 2019 that led to more than 340 deaths. The FAA ordered an inspection of the Boeing 787 Dreamliner back in 2024 after a mid-air dive on a LATAM flight in March injured more than 50 passengers. A whistleblower last year also urged Boeing to ground all 787 Dreamliners worldwide, claiming there were flaws in the plane's assembly. Boeing rejected the claims by the former engineer and said it was fully confident in the plane. Joining me now, we've got Mike Boyd, Boyd Group International President. Mike, thanks for taking some time and hopping on with us this morning. After a tragedy like this, should passengers be worried about flying on Boeing planes, but specifically as we're looking across some of the large plane manufacturing that they do, some of the negligence that's come to be known and the changes that they're making? Is it swiftly enough?
It is. The two aren't really connected at this point in time. There's no indication whatsoever, that what that whistleblower brought up, and I looked very heavily at that, and what happened today, there's no indication. This airplane's 10, 11 years old, okay? It's been flying around. So the real issue, should some people feel safe about flying? The answer is absolutely yes. And we'll know more about this in a few days, because between the NTSB in the US, which is going to be on the scene, and the Indian investigators will have a pretty good idea of what really did happen with this specific airplane.
We do know as well this year 75 to 80 deliveries are projected of this 787 Dreamliner versus the 51 in 2024. Just how vastly different is Boeing today versus some of the issues that they faced in 2018, 2019?
Well, in 2018, 2019, let's put it right on the line. They were an incompetently managed airplane manufacturer. They didn't know what they were doing. They were looking at stock price. The fact of the matter, today, they're a much more rationally run airplane manufacturer. Plus, the FAA is on the scene all the time. Now, keep in mind, the FAA was involved with the poor oversight before, but right now, there's a lot more going on at Boeing to make sure that they're doing things right because they weren't doing it back in 2018.
There are many more details that we're waiting to come from the crash in India. This also internationally comes at a time where many of the airline operators as well as manufacturers like Boeing are gearing up to head to this international air show as well in Paris. How does this perhaps change some of the conversations that take place, if at all?
Well, it depends on what they were planning to do. If they were doing a giant, corkscrew flyby of a 787, I think that's canceled right now for that air show. But I think the bottom line of it it's basically a show and tell of order books. So I don't think it'll have much effect on it at all. And if Boeing's been through this kind of thing before, you just don't keep bringing it up and bringing it up. So I think for Boeing sales, it's not going to have an effect unless we find out something catastrophic, and I don't think we will.
What are some of the first questions that you imagine regulators and those who are investigating will need to bring to light and hopefully the public get some more answers around?
Well, I think in this case, they're reportedly, the crew did call back with a mayday saying we've lost power. And it looked like, from the videos, it's like candid camera everywhere nowadays. It's sort of this pancaked into the neighborhood. So they'll be looking at things like fuel. They'll be looking at things like pilot records. They'll be looking at maintenance records. And I say will be. I'll guarantee you they're doing it right now.
Mike, thanks so much for monitoring this story and joining us this morning on short notice as well.
My pleasure, sir. Thank you.
Switching gears here and tracking the markets as well here this morning. We're about 24 minutes out from the start of trade. The U.S. stock futures right now under pressure after 3 days of gains as President Trump lays out plans for unilateral tariffs within the next 2 weeks. Joining us now, we've got Kevin Gordon, Charles Schwab Senior Investment Strategist here. Kevin, good to have you here in studio with us.
Morning.
As we're thinking about what the markets are paying most close attention to right now, what are you from a strategy perspective really giving more weighting to at this juncture?
This morning it's probably the tariffs just because it's so wide ranging. If that's the expectation that you're going to go back to, imposing a unilateral tariff, in addition to still relatively high and restrictive tariffs on imports from China. We still don't know the details of what the agreement was from the talks in London, but if it is indeed a 55% tariff on imports coming from China, that's still a pretty steep increase relative to where we were before everything pre-Liberation Day. So I think that's probably taking more importance, even though there was a little bit of a bump after you got jobless claims that were unchanged and a relatively favorable PPI number. I think probably more of the concern over the past couple of days, even though CPI was better than expected, PPI was better than expected, more of the concern is probably on the growth side of things as opposed to on the inflation side of things right now.
Within this, we have a point of contact that it seems like the markets give more weighting to. Of course, they're the social media posts, but then there's also Treasury Secretary Scott Bessent, who could then come out and say, well, one of the other things that we're thinking through is kicking the can down the road further and having this broader phase where we can give ourselves more time for countries who have come forward in good negotiation practices. What does that look like for the markets to kind of have a lopsided look at the perhaps overall tariff rate, which investment strategists seem to be giving at least some of the more immediate modeling to right now?
Yeah, I think there's a little bit of a desensitization that happens to markets over time as this goes on. Because, you could even see it with a lot of the comments we've gotten, whether it's from the administration or whether it's some of the headlines, over the past several months at this point. Clearly the max pressure point was at Liberation Day, and then it's sort of subsided since then. We still have the markets reacting to everything trade related, but I think from here, if it's going to be the case that you don't go back to what was announced on April 2nd in terms of tariff rates on imports from all of these major trading partners and the rest of the world, frankly, and if you're going to go into a scenario where the average effective tariff rate is lower over time from that point, but it's still relatively elevated, the focus is probably going to shift more on what does that do to the economy as we figure out what the actual tariff rate is going to be. So what does the slowdown look like in things like CapEx, and ultimately does that lead to hiring? And I think one of the reasons that you've been able to see such a strong rebound for the equity market and such really, I would say pretty impressive participation, at the sector level, at the member level. I think one of the reasons for that, and it's been a really strong reason, has been relatively resilient hard data. You've still seen this big divergence between all the survey-based data and everything that has been, GDP or labor market related. Even within GDP, the underlying business spending numbers have been relatively strong. So taking a step back from the headline being negative for the first quarter, underlying private demand was still relatively strong. That's still expected to be the case for the second quarter. So I think as long as that's the case, where you've got a relatively strong divergence between the two, and there's not as much of a strong catch down for the hard data, you probably have the market focusing more on that and trying to bake in and figure out what's the sort of overall impact as this drags on over time.
That's so interesting because the resilience of the data also points back to the strength of the economy that we'd seen even before the invocation of economic powers to go forward with tariffs and not necessarily have an approach that had a hard deadline as to what we were looking for or the checklist of what we were looking to get back.
Yeah, there was definitely signs and trends that we were slowing coming into the year, but slowing versus being slow are two very different things. So you're right to point out that the relative resilience of the economy, I would point to especially the labor market. I mean, the kind of rebound and recovery that you had in labor, post-pandemic, even though we went through that big inflation surge from 22 into 23, that kind of recovery and that soft landing, which we totally achieved last year in terms of inflation rolling back over, unemployment staying relatively tame, and then GDP growth continuing a relatively solid pace. That's unique to see in history, and that's where we were entering 2025. So this disrupts the picture, certainly, but it just depends on how much.
And so with that in mind, the markets don't seem like they want this to be a matter that gets caught up in courts either, because that places more uncertainty in the mix. How are you reading that?
Yeah, the court, I think what's tough about that is if the administration is really serious about imposing tariffs and doing whatever it takes to get to relatively aggressive tariffs, whether it's to close trade deficits or not, the goal seems to shift almost on a weekly or daily basis, depending on who you talk to, which makes it difficult to assess. But even if the IEEPA tariffs were ruled as unconstitutional and the president can't do that in terms of his unilateral power, there's probably a reasonable expectation that you would see the administration explore other means to achieve what they ultimately want to achieve, whether it's the more temporary ones that stay for 150 days and go up to 15%, or whether it's more targeted in Section 338, which hasn't been used before. So there are a lot more avenues that can be explored. I think that that's probably less important because we know that the end goal of the administration is ultimately higher tariffs as it stands right now. If that changes, then clearly all the calculus for this will change. But as long as the end result or the end goal is to have some sort of tariff for all of these imports coming in, then I think you can expect that that's just going to be sort of the path of least resistance from here.
And so within that, what we've also heard from a lot of strategists is that we could be range bound over the course of the summer. How are you looking through the technicals right now to really gauge where and which parts of the market could see the most relative strength, even within that range boundedness?
The strength has come from interesting areas that you probably wouldn't expect if we were going into, or at least staying in, some sort of global trade dispute. You think of areas like industrials and even areas like financials, which financials are not at the epicenter of any kind of tariff dispute because of there's not really an import bias or any kind of goods-related weakness right there. But you could sort of imagine a knock-on effect if the economy starts to slow. Financials tend to get hit the hardest when you go into a recession or some kind of economic slowdown. But even within a sector like industrials, I find the split in performance among those members pretty fascinating because most of the strength has been on the services side of things, not on the goods side of things. And even those areas with thinner margins. So you look at air freight and cargo and passenger airlines and anything goods related in industrials, that's been lagging. What's been really leading and pushing that sector higher is everything in the commercial services area. So I think even within a sector that has been leading and has been doing well and it skews cyclical, you have to pay attention to some of the messages that are being told. And there's still a little bit of economic skittishness embedded in some of the messages in those sector moves.
Some key strategies to implore and watch play out over the course of the summer. Kevin, thanks so much for taking the time.
Nice to see you. Thank you.
Likewise. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Stocks snapping 3 days of gains, plus Micron planning a $200 billion investment in the U.S. manufacturing. We're going to bring you the details. Oh yeah, GameStop plunging amid plans to raise funds through a convertible bond sale here. What does it mean for the crypto strategy? And we'll discuss that plus more on Morning Brief coming up. Now time for some of today's trending tickers. We are watching Micron, Chime, and GameStop. Joining me to help break them down, we've got Yahoo Finance's Josh Schaefer. First up here, let's set the scene with Micron, Josh. Micron planning to invest approximately $200 billion in semiconductor manufacturing and R&D in the U.S. The company plans to build a second manufacturing facility in Idaho and expand its existing manufacturing facility in Virginia. The investments will create an estimated 90,000 direct and indirect jobs. Shares of Micron just fractionally lower, almost down by about 1% pre-market on the back of this announcement here. And as we were talking about in the break, it really comes down to a multi-pronged approach as to how investors would think about this. Number one, what extent of time would this take for Micron to make not just the investment, but to see the return on that investment come back? And there have been, I would say, far more investors that are out there and saying, okay, yeah, this seems like the time to make these big investment bets in order for the payoff that we're anticipating to come forward over an extended period of time, plus the purchase obligations that they're already starting to try and make sure that they can fulfill on the customer side.
Yeah, Brad, I mean, I think your point on timeline is sort of why you don't see large moves off an announcement like this, right? It's kind of, okay, big number, $200 billion, right? What does it mean as far as, is that a 3-year, 5-year plan? When does this actually start to impact the business here in the US too? I think that's obviously the interesting part of this story as well, right? Is sort of the manufacturing build out in the US that of course has been talked a lot about over the last several months, and you're starting to see those deals get signed with large companies, that is coming to the US. But I think overall for Micron as a stock, you look over the last year, stock's down 14%, hasn't really done a lot. And so I think it's looking for sort of that next leg of growth. Is that going to be part of this deal as we start to sort of digress it, talk about it, and see what some of the analysts maybe are able to pencil in once they get a little bit more details too on those numbers. What does it actually mean for forward projections seems a little bit to be seen.
Right, and in the Trump 2.0 administration, the early days is the art of the deal mindset. How can we bring forward as many of these headlines and announcements? Because at the top of the Micron press release for the investors out there that have been going to the website and lighting that up here today, as well as the Yahoo Finance platform to see how the stock is trading for MU. Micron and Trump administration announced expanded U.S. investments in leading-edge DRAM manufacturing and R&D. Now here's the breakdown of some of those figures just very briefly before we move on. $150 billion in domestic memory manufacturing, $50 billion in R&D, and then an additional $30 billion beyond prior plans for that second leading-edge memory fab in Boise, Idaho. Of course, the land of great blue football fields out there.
Love the blue tariff. Love the blue tariff.
Next up, let's talk a little Chime here on the day. Chime set to make its public debut on the NASDAQ. The online banking services provider pricing its IPO at $27 per share, valuing the company at $11.6 billion. The debut being viewed as a bellwether for other IPO candidates in the fintech industry here. We're going to be watching closely when this one begins.
I'm fired up to just see how the stock trades.
Yes.
Honestly, when you think about how Circle has moved over the last couple of weeks.
Massive reception.
Circle up about 240% from where it opened. You had CoreWeave up about 300% since its IPO in March. I recently wrote about this actually, Brad, looking at the difference between tech IPOs and non-tech IPOs since 2024. So Carson Research had a great chart that we're showing now. Look at the difference between the average price return from the deal price of tech IPOs versus non-tech IPOs. It's essentially double. So the market has really been interested in any sort of tech company. Of course, when you think about the stock market over the last 2 years and sort of what the story's been, this chart makes a lot of sense, right? You're seeing tech companies, companies that are in online banking, companies that are into crypto, companies that are into AI. The market has received those companies well. Does that also happen with Chime and sort of continue this trend? I think is an interesting thing to watch.
You know, it's so interesting because you said the banking services here, and one of the things in their S1 filing, one of the top lines as they start to get into the disclosures and everything, Chime is a technology company, not a bank. And I've posed this question to a good friend of the show, Chris Whalen, before, who covers this space. If not bank, why bank shaped? Because there are so many of the financial services that Chime has become to be known for here. You think about the first quarter of 2025 and what they disclosed. Active members use Chime for 54 transactions per month on average. That's about as many bodega visits as I make per month. 75% of which were purchase transactions using Chime branded debit and credit cards, and then 70% of purchase transactions for non-discretionary expenses made in categories such as the criticals, the food, the groceries, the gas, the utilities here as well.
Yeah, I mean, you just want to position yourself as a tech company, right? For that reason that I said, you want
that multiple.
Yeah, exactly. You want to be a tech company, right? And I think if you look at similar companies, like maybe some other sort of payment online companies, maybe I'm thinking of an Affirm or something, maybe that's not the correct total comparison, but those companies trade like tech companies too.
Absolutely. Offering size, 32 million shares. The offering price here, they've priced the shares at $27 a piece. We're going to be watching closely for when the window opens up, and that will be after the opening bell, of course. And then finally here, we've got GameStop announcing plans to offer $1.75 billion of convertible senior notes. GameStop, they intend to use the proceeds to make investments which could fund some of that Bitcoin buying. Of course, May 28th, everybody became well known with the tweet on that day. Just a very simple S1 filing. GameStop intends to use GameStop, has purchased 4,710 Bitcoin. And then within this release today, they had mentioned that they intend to use the net proceeds from the offering for general corporate purposes, including making investments in a manner consistent with GameStop's investment policy.
Just following the market action here.
Yeah.
It's not working right now, right? This strategy that we're going to stop selling video games and become strategy and become MicroStrategy, just look at the stock. It's just not really working, and they're not getting the retail bid that I think was sort of part of this strategy. I don't know what else would be part of the concept here. It seems like you're going to buy Bitcoin, you want to be like Strategy and Michael Saylor, and it's just not quite working, right? You're obviously going to have to raise money to buy this Bitcoin, and investors aren't liking that. They're dumping the stock. I'm just curious if this starts to work at any point. Like, how do you turn the corner as Strategy has and become a stock that people want to hold because you're going to buy Bitcoin? Feels like it doesn't happen overnight, but does it ever happen for GameStop?
Well, it's also when the notes are convertible and due. They're not due until 2032. So that is something that investors also have to take into consideration. Josh, thanks so much for joining me to break these down. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We got another big company we're watching here this morning. Shares of Oracle are moving higher pre-market after the company beat expectations on the top and bottom lines as it makes a play for the cloud computing market. You could argue they've been making that play. The company brought in $15.9 billion in revenue for its fiscal fourth quarter, with $6.7 billion of that coming from cloud services here. Cloud sales rose 27% year over year in the quarter, and Oracle expects that number to grow 70% in fiscal year 2026. I want to bring in Dan Morgan, who is the Synovius VP and Senior Portfolio Manager. Good to have you here. Good to see you this morning. Just take us into your reaction from the print from Oracle and what the company was saying with regard to its growth prospects.
Yeah, I think that's what really lifted the stock, Brad, was we have to bear in mind that Oracle over the last 10 quarters has missed 7 times, and they missed the last 2 prints. So this fourth quarter 25 number coming in above expectations was obviously well received. And then, like you alluded to, is really the guidance that they gave going forward. I mean, some of the things that really stood out to me, you mentioned cloud infrastructure as a service. They're expecting that growth rate to go from 52% to about 70%. They're actually looking to double the number of data centers, multi-cloud data centers, from 23 to 47. So I think it was, Brad, the guidance that Oracle gave going forward for fiscal year 26 that got everybody really excited in terms of the future growth of the company and appreciation for the stock price.
You know, as investors try to consider and evaluate the safest non-chip AI play, as we hear results from companies like Oracle and other software, CRM, ERP companies like Salesforce, SAP, are they trying to solidify themselves, position themselves as the next best additive to portfolios and the play for generative AI in the future that all of them are trying to power forward with agents?
Yeah, so Brad, if you think about the chip makers like NVIDIA and Broadcom and Intel and Marvel, of course, that is a heavy, heavy AI play in terms of growth. And everyone gets worried, right? Because, you see the headlines, PCs and smartphones, tariffs, and all these other things. But then you kind of switch gear over to like an Oracle. You got to bear in mind that about 45% of the relational database market they control. They have over 400,000 customers. They're also a major player in enterprise resource planning. And now they've geared over towards competing against, let's say, Microsoft and Azure, or GCP out of Google, or AWS out of Amazon in the cloud space. So they're not as reliant or as susceptible to potential increase in tariffs on hardware like smartphone and chips. Now, bear in mind, Brad, they're talking about these huge build-outs that they're going to do in terms of data center. They're also saying that they're going to require $40 billion of GPUs that will most likely come from NVIDIA. So they are susceptible to a certain level in terms of supply constraints with components to build out these data centers. But they seem to be in a better position when we think of AI than, let's say, some of the chip makers who are so reliant on manufacturing in China and the Pacific Rim, who obviously would be devastatingly impacted by tariffs.
Dan, I only got about 15 seconds left here. We've talked a lot about valuation over the course of this week and how many companies have gotten ahead of their skis. Where does Oracle sit within that capacity and mind frame?
Well, just real quick, Brad, they traded about 25, 26 times earnings, pretty much in line with their historical level. So they're really not overvalued like you would think of as a really high PE multiple tech stock. So they're pretty much in line with their historical levels.
Dan, good to see you this morning. Thanks so much for
Thank you,
taking the
Brad.
time. We've got all your markets action straight ahead. Stay tuned. You're watching the Morning Brief. We're taking a live look at the opening bells at the New York Stock Exchange and in Midtown Manhattan at the NASDAQ, where Chime is ringing the opening bell. It's IPO day. Ooh, they got a special button that they're using for Chime today. All right, we're going to be watching them closely. We've already got, of course, a look at the offering size earlier, as well as where they price shares. We're going to keep tabs on that one as they get closer to their first trade. Also here, we're taking a look at the open on Wall Street and taking a look at the Dow Jones Industrial Average. We open lower right now by about 0.3%. This is where futures were kind of indicating that we would open with some fractional declines here. We're going to be watching this closely, the S&P 500. That too, also moving lower out of the gate right now, lower by about 0.2%. NASDAQ Composite about the same on a percentage basis. Let's take a look at some of the heat maps that we've got dialed up for you here. The 11 S&P 500 sectors mixed right now. Technology leading the pack. That's up by about 0.2%. Let's put this on a year-to-date view just so you can see what has transpired over the course of this year. And my goodness, it has been a ride. But taking a look at things year-to-date, we are still holding on to gains for XLK. That's up by about 3.5% over the course of this year, despite that wild ride. The energy sector, that right now you're seeing year-to-date flat just barely to the downside, and here today it's lower by about 0.8%. It is the biggest laggard out of the gate, at least this morning. Let's take a look, since we mentioned technology, at the NASDAQ 100. As we are kind of firing up an equal view here, you can see we have just a few more laggards than gainers. MicroStrategy, formerly Strategy though, it's known as Strategy now. They rebranded and all that jazz. Right now, they're down by about 3% at the gate this morning. Datadog leading the pack for the NASDAQ 100. And then also want to take a look at the Dow Jones Industrial Average, as we are seeing a lot of mixed activity here. Boeing, the biggest decliner there, of course, off of the fatal crash taking place in Air India. We're going to continue to watch some of the developments coming forward from that story. And as we're seeing Boeing out the gate here this morning, it's moving lower by about 5%. United Healthcare, that's your biggest gainer, as right now at least. Amgen, Microsoft also rounding out those top three gainers for the Dow Jones Industrial Average. Those 30 components largely leaning negative to start off today's activity. And then let's go to a market that never closes, cryptocurrency. As we're taking a look at Bitcoin, right now we're seeing things move lower here over the course of the past 24 hours here year to date, still holding on to gains. But right now, moving lower by about 2.7%. We're still holding above this 106,000 threshold here. So not quite scratching up against those new all-time highs just yet, but we are about $5,000-$6,000 off of that as of right now. We'll continue to watch that as we move on throughout the rest of the day. You got a lot of red on the board here for some of the other cryptocurrencies as well. It's also a big Coinbase conference day too. We've got much more on that later on in the show, so stick around for that. But let's switch gears. It's time now for today's strategy session. Economic data, oh yeah, it's sending yields lower. Has investor increased the odds of a Federal Reserve rate cut this year? So joining us now, we've got Brent Schutte, who is the Northwestern Mutual Wealth Management Company CIO. Great to have you here with us as always, Brent. So just take us into your evaluation of what is really driving the markets right now.
Well, I think today it's a combination of the lower inflation prints that you've had over the past couple of days, which are good news. But I think the bad news is that the economic data overall is showing signs of weakening. So at 7:30 this morning, you had initial jobless claims, which are continuing in an uptrend and show a labor market that may actually be weakening a bit more than what people thought. And so that's where you're kind of getting this good news, bad news scenario where you're seeing better inflation data, but it may be coming from consumer spending that's pulling back. It may be coming from the jobless market beginning to weaken. And that's kind of where we're in a delicate balance between the good and the bad news.
And so with that in mind, it seems like the additive on top of that is the market's realization of, okay, well, when will the Fed step in and pronounce any type of major policy decision in the form of cuts?
I don't think it's for a little while yet. Look, the inflation data is good, and people are suggesting that maybe the tariffs won't have an inflationary impact. I think it's too early to decipher that. And so if you think about all the inventories that have been pulled forward by importers, by consumers, by businesses to actually study and ready themselves for the tariffs, that may be impacting the inflation data right now. And it often has taken time in the past for that to show up in the actual numbers. If you see the soft data still, the ISMs last week, they point to companies that are looking to actually raise prices in the future. And that's where I think the Fed is going to stay on the sidelines, which means we're kind of in this wait and see time period. And that's where I don't think the Fed likely cuts until September, unless you see significant weakening in the labor market. And then the question is always, is it too late or not?
So in the absence of Fed Chair Jay Powell and the FOMC swooping in with capes to save any type of momentum or at least sentiment or fervor, and an absence of whatever could come forward in the form of negotiations on tariff policy and trade deals, what is an investor to do?
I think diversification is great again. And so if you think about all your opening, you focused on US markets and technology stocks. I think the good news is those were the only show in town for the past couple of years. I think there's a new show in town. And that's where I think international stocks, for example, are primed to do better in the future. That's where you look at things like the US dollar, which I think the administration and their policies, they want that dollar to fall to help shrink our trade deficit. You may see repatriation of cash flows or cash out of the US from foreign investors looking to invest in their own markets, where now those economies are thinking about stimulating their own economic growth. And that's where I think investors need to make sure they're diversified. I think international stocks, after being kind of sleepy for some time, now have that catalyst. I come back to even in the US, there are opportunities outside technology. I think about the broader S&P 500 being a decent opportunity, but even more so small and mid-cap stocks, which when there's this much uncertainty, I think you pull back and you look at valuation. And that to me is where small cap stocks, at least in my 30 years of doing this, traded the second lowest valuation relative to their large cap counterparts. The other time was June of 2000, which ushered in a period of small cap outperformance. And so I think there's lots of opportunities, but the biggest request that I have for your listeners is to think outside of those areas that you just opened the show with and make sure that you have exposure across the spectrum to broader equity markets.
Brent, as we're hearing that from many investors and investment strategists, that they're expecting and anticipating this range-bound type of summer and not quite a nothing burger, especially knowing that early July, we're going to see either trade deals come through or the can kick further down the road. Plus, you've got an FOMC meeting in 7 days that's going to kick off? Less than that, 5 and 6 days here for that 2-day meeting. Plus, you've got even more of the decision making that's going to take place on that front. As you're kind of evaluating what will kick off for certain is earnings season. And we're going to hear from companies that either were able to further reaffirm now or get back to their full year expectations or continue to just have this massive uncertainty. What are the anticipations going into that earnings season?
Look, this is where people are paying a high price for a lot of the earnings these companies are producing or are perceived to be producing. And that's where I think that the stakes are high. I mean, if you actually have an earnings miss on any one of these lofty valuations, that's where there's downside risk in the markets. And I'm not suggesting that there won't be the opportunity for these companies to meet. It's just that a lot of the price has already been priced in. And that's where I encourage people to look outside just those companies and think about the broader spectrum of companies that are out there where expectations may be a bit lower. And this is where I think uncertainty comes to the fore. We'll see who gets to pay the tariffs. Do consumers pay some of those? Is it foreign exporters only, which I don't think is the right answer. I think it's likely that some companies will have to absorb some of those, which I guess the good news is margins are pretty high in some companies. So you need to be company by company on those. I guess back to my bad news, though, investors are already paying a pretty high premium for the margins that produce the earnings that you're referencing. And that's where I think there's possibly downside risk in the future.
Interesting. Brent, thanks so much for taking the time here with us.
Thank you.
Let's get to the 3 market movers you need to watch for the trading day. Yahoo Finance's Jared Blickery has more.
Thank you, Brad. I'm watching some of the major indices kind of stalling out very close to those record highs. Nothing too concerning, but I'm also watching the dollar and rates plunge, why that could actually be a bright spot for equities. And then I'm taking another look at Bitcoin after just kind of following up on some of the points that you were looking at, Brad, just a minute ago. So let's start with the S&P 500 behind me. First, I will show you it is still holding on to the $6,000 price level. If we take a look at the week's action so far, still a little bit of gain, although we're off about 17 basis points today, up just marginally from the week, though notably off of these highs that we saw on Wednesday. And then if we take a look at the NASDAQ, kind of a similar situation, still holding on to some gains, but well off the peak here. And then let's take a look at the Russell 2000, or excuse me, S&P 600 here, giving back almost all of the week's gains, but Russell 2000 is in a similar boat, both of those tracking the small cap stocks. So the outperformance by the Russell is kind of leading to the downside today. We're seeing underperformance today. And just taking a quick look at some of the sector winners for this week, energy and tech have been topping the mix here. You can see utilities and tech are topping it today, but we will go to a 4-day view, and there's XLE, and now XLV has just overtaken XLK. So healthcare in the number 2 spot, but tech in number 3. What's not working this week? Industrials, financials, staples, and materials. But going back to our list here, I want to highlight what's happening in the dollar and rates. So first, the dollar has really been catching my eye. I've been talking about how it has been hovering near 3-year lows. Well, it broke those lows today. So this is a 4-day price action there. It's down 1%. That is a lot in commodity or dollar terms. If I go to a 6-year chart, you can see, and I'll draw a line here, we are looking at the lowest prices since 2022. So we have broken to new 3-year lows. And critically, we have decisively broken this trading range that we saw develop over the past 3 years. So there's potentially more downside here. But what gives me some optimism is that yields are following to the downside. Now, yields and bond prices move inversely. So this means that investors are buying those bonds. This is the opposite situation that we saw immediately after we saw all those tariff hikes a couple months ago. So that was a dangerous situation because the world was selling U.S. assets, including the dollar, selling bonds, but that's not what's happening here. So that's my ray of hope. Also going to watch for a 30-year auction at 1 p.m. today, 1 p.m. Eastern, and that's something that we want to keep in mind. The auctions for the 10 and the 3-year earlier this week, those went well. So some optimism going into those reports as well. I want to show you briefly what's happening in commodities, and then we will move on into Bitcoin. Here's a 4-day look, but let me dial this down to a 1-day. Just want to highlight that crude oil now sinking a little bit. It's still at 67.27. This is WTI. Here's the 4-day price action. I was saying 65 was a key level. It is definitely holding that. It is broken above 65.66, holding that level. And also taking a look at platinum. Platinum was kind of a leader this week, but it is now falling off of those highs. Here's the 4-day look again. Here's a peak that we saw a couple days ago, or yesterday to be more specific. So nothing concerning there, but just noting that for the files. And finally, I will end on crypto. Here's that red leaderboard once again. Bitcoin, is this concerning? Well, it hit 110,000. It's still consolidating near highs. Here is the year-to-date chart. So no, I don't find this concerning, but I do think we need another catalyst to get to those new highs. And by the way, the Ethereum breakout that we saw, that is still holding the breakout levels, so that's encouraging as well. But again, we need that catalyst, and I'll send it back to you, Brad.
Jared, thanks so much. Teeing up today's market activity. Appreciate it. Coming up, GitLab's guidance falling short and disappointing Wall Street. GitLab CFO Brian Robbins joins me next to break down the state of the business. You're watching Morning Brief. GitLab's second quarter revenue forecast falling short of estimates, and still the application software company's first quarter results beat expectations, with revenue climbing 27% year over year. Joining me now, we've got Brian Robbins, GitLab CFO. Brian, thanks so much for hopping on with us. We just saw a look at shares. They're right now just oscillating between gains and losses here. Investors trying to really get their minds around the quarter. Walk us through the state of the business right now from your lens.
Yeah, absolutely. Thanks, Brad, for having me on. It's great to be back. As you know, we reported earnings 2 days ago. We reported revenue growth of 27% year over year, great non-GAAP operating margins of 90%, and we produced over $100 million of free cash flow. We beat our number, the consensus number, but it was a smaller beat than we usually beat. And then we kept the annual guidance as what we committed to last quarter. And so there was on the callbacks, the investors were looking for a larger raise and to pass through the beat that we had in 1Q.
What are you seeing among your largest client base right now? I know you talked about Supermicro and how they're scaling up and looking across some of the size of their software team, upgrading from the free tier in Q1. And so now a large customer and also a paying large customer as well. What are you seeing among that cohort of your business partners?
Absolutely. GitLab, between our enterprise business and our federal business, represents about 72% of our overall business. Every company today has to be a software company. GitLab enables companies to build software better, faster, cheaper, and more secure. And so we're seeing a number of companies adopt the platform, which enables them to increase developer productivity, improve operational efficiency, reduce security and compliance risk, and also accelerate the digital transformation.
And so where are you seeing the opportunities right now to, beyond that outsized 72% of the revenue base, expand further into other sectors where there's an opportunity for GitLab to entrench its own recurring business opportunity?
Yeah, we are a ratable business model. So most, about 90% of our business is ratable. We have cohorts from 10 years ago are still expanding with us today at the same rate as cohorts were last year. We reported a net dollar retention rate of 122%, which is best in class for software companies. And so every company has to be a software company, and we're helping them do that. And so whether it's a large enterprise, whether it's a small financial institution, whether it's a transportation company, GitLab has approximately 50% of the Fortune 100 companies as customers today.
You've made it into the Cathie Wood portfolio. What is the significance when you know that there's such a kind of forward-looking and innovative focused type of portfolio and fund that's been put together that now has GitLab in it?
Absolutely. We spoke to Cathie yesterday. Her and her team are great, asked a lot of great questions. We have a lot of great shareholders and investors across the board. I think it just really shows what the opportunity is for GitLab.
And so all these things in mind, as you think out to the deal sizes and also deal scrutiny, as there are some who you would like to see convert from that freemium model on into longer run paid subscribers and purchasing seats for within the GitLab platform, how is AI also fueling some of those conversations?
Yeah, great question. Everybody's talking about AI today. There's been a number of companies who have grown very quickly related to AI. GitLab is injecting AI in the entire software development lifecycle. One of the ways we're a little bit different is we're open source and allow code creation. We actually put security and privacy at the forefront. We allow people to bring their own self-hosted models. We have a knowledge graph that we're creating all the context to allow the AI to help developers become more productive. And then we're actually injecting that AI throughout the full software development lifecycle. So there's a number of different AI tools that we have today. One is Duo Pro. We have Duo Enterprise, and then we're also in the winter launching some of our agentic AI features, which will allow the computer to actually go in and do bug fixes and various functions to help the developer become more efficient.
Great to have you here with us, Brian, and thanks for taking us into some of the key drivers of the quarter and the outlook. Appreciate it.
Thanks, Brad. Appreciate it. Have a great day.
You too. Coming up, we've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. Oil prices are falling off the 2-month highs we saw earlier this morning as investors consider escalating tensions in the Middle East. Here with more, we've got Yahoo Finance senior markets reporter Inez Ferre. Hey, Inez.
Hey, Brad. Yeah, and those tensions in the Middle East has kept oil volatile over the last few sessions. I do want to show you what's happened over the last two sessions here. We saw oil yesterday really jumping more than 4%, as much as 5% in the late afternoon. And this is because of tensions in the Middle East. First of all, reports that Israel is considering military action against Iran without the help of the U.S. And also yesterday, we saw that big surge after the U.S. State Department had said that it ordered the departure of non-essential personnel from the U.S. Embassy in Baghdad, Iraq. So a partial evacuation of that embassy because of threats in the area. So you had seen oil yesterday really rally off of that. You also had President Trump yesterday in a podcast that was released saying that he was less confident about a nuclear deal with Iran taking place. Now, remember that Iran is a big oil producer. They produce more than 3 million barrels of oil per day. They export a lot of oil. So if you have a supply crunch with Iran, then you would see oil prices going higher. Now, we have seen, look, in April, you had the biggest monthly drop in oil since November of 2021. That was because of demand fears. That was because of the tariff situation and because OPEC Plus was increasing supply. But we have seen oil really rally off the back of those lows. And so year to date, right now, we're looking at WTI down about 7% year to date, with Brent crude down about 9% year to date. 69 for Brent, 67 for WTI. Some Wall Street analysts still think that oil is due to go down a little bit further than that, with Goldman Sachs predicting that $60 Brent for oil, Brent oil at $60 for the rest of 2025, Brad.
Inez, thanks for charting this out, breaking this down for us. Appreciate it.
Thank you.
Let's get a quick check of the markets as we approach the top of the 10 a.m. hour and before we head to break. Taking a look at the Dow Jones Industrial Average right now, we're down by about 0.4%. The S&P 500 flat just barely to the downside there. That's just a little bit better than where we started off today's trading activity. The NASDAQ just about at the same place where we left things, or where we began things, I should say, to begin today's trading session. That's down by about 0.1%, just a little bit more than that. We've also been keeping tabs on NVIDIA, ticker symbol NVDA. Of course, a lot of announcements that have been coming forward on the robotics front there. We'll be watching that. That does it for Morning Brief. Join me in the next hour for more analysis on Catalyst.